All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. We're going to go out here with our sixth class here for Education Week, leading us up into the challenge that kicks off tomorrow. We're very excited about that and looking forward to that. Let's go out and talk about option pricing is in regards to risk and reward. Okay, and I'm gonna kind of bring up some theory here with you at first. Those of you who have been with us for a while, you've heard this, and every time I talk about it, I have to kind of highlight this is theory. Okay, and theories always sound good, and they always look good. In practice, you're not going to see the theory play out as cleanly. Okay, but over time, you'll see the theory come into play here. So let's kind of break it down. Risk versus reward. Okay, what is the part of the market that we can control? I mean, when we look at the market, when we look at trading, when we look at charts, whatever it might be, what's the part we actually have control over? Because we really don't have control over a lot, do we? I mean, we don't have control over upgrades, downgrades, earnings. We don't have control over, whether Warren Buffett decides to buy into a stock we're short or sell a stock we're long. We don't have control over 99.999% of the variables that are out there. But what do we have control of? Okay, we can control our risk. Okay, we can control our risk. The whole mentality of the challenge is to control the risk, right? I mean, we're not doing it from a trade by trade basis. We're doing it from hey, what's our max risk here? It's $3,000. That's our risk. That's how we're controlling the risk. We're taking a small amount of money, okay, well, small being a relative term there, but a controlled amount of money. We know that's what our risk is, and we can control it. If something weird happens, let's just say, heaven forbid, something drastic happens and the market gets cut in half tomorrow. Well, if we're in all upside plays, still the most we can lose is 3,000. Okay, no matter how bad of a trading streak you go on, the most you can lose is 3,000. That's the idea behind the challenge. Okay, and controlling our risk. Now, for each individual trade, we can also go out and control our risk. And think about it in this way. Okay, think about it in this way. Go with risk versus reward. Okay. With an option, is it that difficult to get 100% gain? I mean, those of you into Tesoro calls, I mean, 3 days later you have well over 100% gain, right? Okay. With options, much different from stocks, we have the potential for 100% gains. And so whenever I go set up an option trade, I'm looking for a 3-to-1 reward to risk ratio. Okay, a 3-to-1 reward to risk ratio. I'll show you how I go and calculate that. Okay, but what does that say? If I'm looking at a 3-to-1 reward to risk ratio, how often do I have to be right to make money? Okay, how often do I have to be right? Those of you who remember the March challenge, we doubled our money being right only 30% of the time on our trades, and we still were able to double our money. How is that the case? Well, okay, if we have 3-to-1 reward to risk ratio, let's say we make 10 trades. Okay, we lose $100. Let's just say 7 times. Okay, we'll lose 7 out of the 10, $100 7 times. We're going to lose $700. Okay. Well, if we have a reward of 3, so every time we're right, we make 3. We're right 3 times. We basically make $900. So in all, being right 30% of the time, we're still in a profitable position from a theoretical standpoint. Okay. Now, is this easy to do or to mimic in the market? Well, it's not terribly difficult. Okay, but you should be where you're able to maybe be right 40% of the time. You should still be making money. Okay. Now, will you go on streaks that are less than that, greater than that? Absolutely. And the times where the challenge really kicks up. In fact, those who were on the last November challenge, when we ran up from 3,000 almost to 40,000 within 2 months, we were only running on a 60% clip of being right on our trades. It wasn't like we were right 80, 90, 100% of the time. We were only right 60% of the time. Okay. And so this whole concept of risk to reward really comes into play. Now, we're dealing with options. Okay, we're dealing with options and real world. Whenever, whenever we buy an option, okay, true risk is 100% of the trade. Okay. Why do I say that? Well, because you may set up, or we may set up good risk reward parameters, right? We may set up some fantastic risk reward parameters, but maybe something gaps. Maybe something weird happens. Maybe the company gets bought out. Maybe it pulls an Enron. Maybe it does something weird, where it moves above and beyond or below and beyond our stop, to where instead of sitting at what we expected to be a 25 to 30% loss, we're now sitting at a 90% loss just by waking up in the morning. Okay, so that is always on the table when we're dealing with options, and we need to keep that in mind. Okay, one of the reasons I'm looking for 3-to-1 risk-reward ratio is because it will account for some of this. For some of this happening. I mean, we can make good money at a 2-to-1 reward to risk ratio. If we're right every once in a while. Okay, we can make good money at a 1.5-to-1 reward to risk ratio. But the 3-to-1 helps to account for this true risk that, hey, you know what, we're going to have some options that are going to go worthless. And that's part of the game. That is part of trading options. You're also going to have options that appreciate in value well over 100%. But we have to understand what we can control, and all we can control is our risk. Okay. So on a trade, how do we set this up? I mean, how do we look at this? How do we say, well, what's our risk versus our reward? Okay. Well, let's go do that. Let's go evaluate our risk reward. If there's a stock you'd like me to do that with, go ahead and put it in to the chat. I have a couple stocks in mind, but we can do this with anything that you're looking at. While you're putting some in, let's go take, for example, we talked about Honeywell yesterday, right? I know some of you got into the Honeywell calls. We talked about the tremendous bullish chart here on Honeywell breaking out. Okay, so let's just say Honeywell breaking 88 here, probably or likely to go higher. What's the risk reward of getting in here? Okay. Well, what can we control? First thing we can control is the risk. Okay, so what's the risk? Well, this is where we have to decide, where do we get out? Okay, where do we pop out if we're wrong? Okay, assuming that there's not a major gap, okay, that we can't account for. Okay, where's that place? Where do we pop out? Okay, this is where you kind of have to use some of your technical knowledge or some of your own judgment with it. With Honeywell, okay, basically looking at yesterday's close. We got a beautiful breakout. We start to move below yesterday's close. That means we're not really breaking out, right? I mean, the breakout's a little false if we move below yesterday's close. Okay, let's use yesterday's closing price, for example, as a stop, which it's about the same price as today's low. So let's just estimate that up here at 87.40. Okay, so 87.40. So with Honeywell, we want to be out at 87.40. Okay. Now, I'm going to drop that by 20 cents. Just because in the real world, you're not always, sometimes things are just going to move a little too fast. You're not going to get out at that exact price. Let me kind of build a little bit of a cushion there. If I was dealing with a stock like Tesla, Ram 10 thanks, I would put a bigger cushion. Okay, and I'll show you that with Tesla. So out at 87.20. Okay, great. we can control that to some extent. Well, what's our price target? And what price target are we looking at here? How far do we think this goes up? Do we know? Can we make an estimation? I mean, just from the pattern here, we're at least looking at low 90s, 90 to 91 would be the typical here. You know, depending on your chart pattern or your breakout, you can get different price targets, but something realistic around $90 to $91. Okay, would be realistic, you know, for this breakout. Okay. So let's go price our option. Let's go figure out what our options could be worth at those levels, and go see if this makes sense from a risk reward standpoint. Okay, so we're basically looking at Honeywell target. Okay, Honeywell target, and let's just use a conservative number of 90.50. Okay, could it go above there? Sure could. Can it go below? Sure. And then we're pricing this out at the price it is now, 88.22. Okay, so let's go to cboe.com. I think Carl showed you this website yesterday in his class. So we'll come in here to cboe.com and let's price these options. I'm just going to come up here to Tools and down to Options Calculator. Now, some of you have broker accounts that'll do this, or other websites that'll do this. And fine, use those. This is just a free one that I'm showing here that can be used. Okay, so here in the Option Calculator, we're going to put our ticker symbol. We're going to put Honeywell. I'm going to click Enter and go with it. Okay. Now you'll notice that this option calculator will always fill in with yesterday's data, okay, yesterday's numbers. It won't fill in with today's numbers or update it in real time, okay. So I have to go make some of those adjustments. So Honeywell, we said, what's the price? 88.22, okay, 88.22. Well, now we have to go decide, well, which option do we want, okay. Which Honeywell option do we want to buy? Do we want November's? Do we want weeklies? Do we want December's? Okay. Whenever I'm pricing risk reward, the option that I start with is between 15 and 45 days out. Okay. 15 to 45 days out, and first strike in the money. Okay. First strike in the money. So I'm going to start out here with the December 87.5s. The December 87.5s. Okay. All right, what's the price of them? $1.90 to $1.94. Well, let's go see if our calculator agrees. Okay, so we'll come here. We'll look at the December 87.5s. Click on Calculate. It tells me my option value should be about $1.82. Okay. Yes, this is being recorded. Okay. My option value about $1.82. Okay. Well, is that the option value we see? No, it's about $1.88, $1.90. Why? Well, our stock just ticked up, right, in real time. So let's change our price here. Let's go to 88.27. Let's see if we get a little uptick in the option price. Okay, 185. 185. Are we trading 185? No, not perfectly. It's actually a little higher, right? Actually a little higher. Why would that be? Why is our calculator giving us a different price, albeit slight, from what we're seeing in the real world? Okay. Well, it all comes down to volatility. Okay, it all comes down. Volatility is that part of the Greeks with options. That's kind of the garbage can, the catch-all. Okay, it basically accounts for everything that can't be accounted for. We can account for interest rates, dividends, expiration, strike price, stock price. We can account for everything except for volatility. So it's kind of like the garbage can. You know, option trader doesn't know, it must be because of volatility. So let's bump this volatility up. Probably don't have to bump it up very much. Let's go to 15.2. We get $1.86. Okay, let's go 15.3. We get $1.87, $1.88. That's about where we're at. Close enough. Okay, I'll bump it up just a little bit more on the IV, and we're there. Okay, we're there. We're seeing what's in real time, okay, on our calculator. So now let's go back and say, okay, you know, what's our option going to be worth if Honeywell breaks 87.20? So our call option, that's $1.89. If I come down and change this price to $87.20, okay, I'm not going to change any of the other variables. Let's just say it drops to $87.20 right now. Our option is going to go from about $1.90 down to about $1.36. Okay, $1.90 to $1.36. So what? About 55-cent risk. Okay, about 55-cent risk. Let's say that takes 7 days to happen, right? Let's take some expiration on here. Let's just assume a week and we get stopped out. Well, we're talking about $1.20 on our option. So what we can go buy right now, okay, for about $1.90 will be worth about $1.20 a week from now if it breaks our target. Okay? So we're looking at what? Okay, what's our risk? What's our risk? Okay, on a 190 option, risking about 70 cents. Now, look, real world, apply volatilities are change. The time it takes for that to happen can change. So we're just getting an estimate, about 70 cents. Yeah, so what, about 35% of our option value at risk? Somewhere in that range? Okay. So we're risking about 35%. However much money we put in, we have about 35% at risk. All right, well, let's say our option value in a week, okay, we'll keep our week days to expiration. Let's say it goes to our price target of $90.50. Okay, what's our option going to be worth? From $1.90 up to $3.24. Okay, up to $3.24. So what? We're getting about $1.20 here. Okay, we're getting about $1.20 in reward. Okay, a little bit more, $1.30, $1.35. Okay, so our reward, let's just estimate here at $1.35. So we're risking 70 cents for $1.35 reward. What's the ratio here? Okay, what's the ratio? Well, it's about 2 to 1. We have about 2 to 1 risk to reward, or reward to risk, excuse me. So we have about $1.35 reward to 70-cent risk. Is that terrible? No, not at all. Would I like better? Yeah, I would. I'd like 3 to 1. Because I got to account for the fact that some of my trades are going to go completely the wrong way. I won't be able to get out. I'll end up with 100% loss. And so if I'm at 2 to 1 on everything, that's just not a great margin for error. Okay, so I prefer to be around 3 to 1. So I can go and look, well, am I underestimating the price target for Honeywell? Could Honeywell go higher? I mean, we can make that argument, with this little dip back here, September, October, about $5, looking for about a $5 breakout from 87, $92 price target. If we just bump up our price target $1.50, we're at 92. And now we're looking at an option that's at 456. So we have something that's gone up well over 100%. It's now gone up $2.60. Okay, so if we use 92 as a target, okay, Honeywell target at 92, okay, our reward, okay, is about 260. Okay, about 260. Well, that's a pretty good ratio, isn't it? Compare that to 70, we're almost at a 4 to 1? Almost a 4 to 1 reward to risk ratio. Not bad. But you have to ask yourself, is 92 realistic? Is 90.5 realistic? And this is where you have to really be honest with yourself. Are those prices realistic? Okay. If you're comfortable that they are, you're comfortable with the trade, you're comfortable with, most importantly, this risk, what you can control, go for it. Put on the trade and go for it. Okay. Let's take another stock. Let's go with let's take the OIH, and assuming downside, right? So OIH, let's pull up the options here, and let's just say you're looking at the put side, and Let's pull up the chart. Let's see where's our stop point. Where's our stop point? Where's our price target? Do we want out if it goes above 51? Do we want out if it goes above 51 and a half? Do we want out if it goes above 52? One of the problems I have with this type of a trade here on OIH puts is I know my risk is 100% because look, I like OIH puts here. I like them even more at 51. I like them even more at 51 and a half, meaning as it goes up and as the trade goes against me, I know I'm not going to get out because it's going to actually be more bearish in my mind. Okay, if that's the case, you kind of need to avoid the trade. If you can't pick a stop point, if you can't pick somewhere where you say, you know what, this is where I have to be out, you probably want to avoid the trade because you're stepping into 100% risk. Let's say for kicks and giggles, we'll use the high from Monday as the stop point here on OIH, 5110. Okay, 5110 is our stop, and we're looking at a price target. Let's just do a conservative price target of 48. Okay, of about 48. We'll calculate it with 49 in the lower band, and we'll calculate it with 48. Okay, so 5110. Let me write these numbers down here with OIH. Okay, OIH 5110 stop, and OIH will price two targets. We'll price 49 and we'll price 48. Okay, so let's go and we're looking at the stock price here of OIH right now being at $50.52. So let's go price them. Okay, what option are we going to use? Well, let's go 15 to 45 days out. Let's just look at the first one in the money. We're talking about $1.50 for the December 50 option. Okay, $1.45, $1.50. Let's price it at $1.50. Okay, so $1.50 option price. Okay, 150 option price. All right, let's come into CBOE. Put on the OIH. We're looking at the December. Okay, the December 50 strike. See what they should be worth. Let's put today's price of the of the stock in. 50.56 is what it's trading at right now. So we should see the option value between 140 and 150, right? You're right. You're right, Max and Steve. I apologize. I priced the calls. Excuse me. Let's go price the puts. Okay. So we're dealing the December 51s, right? The December 51s, $1.35 to $1.40. Okay. Thank you. Okay. Thank you. Okay. And so for OIH here, okay. Yeah, Dr. Trump said it's OHI. Let me double check here. Yeah, I originally put OHI. I think I corrected that here. Hopefully that's showing on your screen. Okay. So the December 51 puts, $1.35 to $1.40. Let's just say they'll cost me $1.40. What are they trading at right now? Okay, the December 51 strike. They're telling me they're $1.30. But the value should be $1.30. But when I go and look at what's happening in real time, it's 135 to 140. Okay, what's happening? Well, is my stock price right? I mean, it's at 50.55. Do I have my stock price right? Yeah, about, right? I mean, it's not that big of a difference. So what accounts for the difference? Why the difference? Well, implied volatility probably a little higher. Okay, and IVs in general have risen a little bit here today. So let's just take the IV up to 16.8. Okay, we're talking about our put option here as $1.32. We're paying about $1.40 for it, so I need to bump up my IV a little bit higher here. Okay, close enough here for our put option. Okay, we kind of have it right in that range. Okay, where was our stop? Our stop's at 50.52. Okay, if it goes, that's our current price. Our stop's at 51.10. So let's just put in 51.10. Let's say it takes 7 days to get there. Our $1.40 option would fall down to about $1. Okay, about $1 is what it'd be worth. Okay, so I'm risking what? 40 cents? 40 cents? Less than a third, so about 30% risk. Just right in line with where I like to be. 25 to 35%. So we have about 30% risk. What kind of reward potential do we have? Well, let's price it to say OIH goes to 49. Okay, our $1.30 option goes to 2.30. So we make 90 cents to $1. Okay, so we're risking. Okay, so we're risking 40 cents for a 90-cent gain. All right, that's a little better than 2 to 1, right? A little better than 2 to 1. Just at that conservative target of 49. A little more aggressive target would be 48. Well, this will give us a reward of much greater. Okay, we go from $1.40 up to $3.10. We're talking over a double. We're talking about $1.70 gain here. Okay, so we're basically risking 0.40 for $1.70 gain. Okay, these are the facts. Before making the trade, are you comfortable with that? Are you comfortable with that? You comfortable with the 40-cent risk? You comfortable with the reward potential? In this case, I'd be very comfortable. Okay, this is kind of perfect, Yeah, my target, it's not quite 3 to 1, but I know there's 48 potential here, which would be a home run. But even just a little overshoot of 49, I'm in a very good place. Okay, so overall, we're talking about a really good risk to reward setup using the 5110 stop. So now you have to say to yourself, all right, am I being honest with myself? Are there triggers to say this is going to go down? Yeah, it's a good setup. If it goes down, it's going to pay off very nicely relative to the risk you're taking with 5110. But are you going to get out of 5110? Really? Or are you going to look at it and say, you know what, maybe I should be adding more at 5110? Okay. This is kind of where you have to be honest with yourself. So you can do this with any stock. Okay, and I appreciate all the stocks that you've put in. I will go through and talk about each one of those with you after the class. But this is kind of looking at your trade from a risk-reward standpoint. Okay. Are you comfortable with it? 3 to 1 is what I tend to target on a risk-reward when dealing with directional trading. Okay, when you're dealing with spreads and some other types of trading, the 3 to 1 is not going to be realistic. When you're dealing with calls and puts on a directional standpoint, that is very realistic there. And most trades you should be able to set up 3 to 1, if not better, depending on where your target is. Now, I'm not going to take something like what was the first one? Harry, ACAD, right? I'm not going to take Acadia and go, ACAD, I think this is going to go to 12. Let me price out what my option is going to be worth if it goes to 12. Am I happy with that? No, that's not realistic. Could it happen? Yeah, I mean, it's a pharmaceutical. They come out with some bad news on one of their tests, it'll go below 12, right? But if I'm looking at Acadia, I'm saying, okay, if I'm going to short it here or buy puts here, I'm going to put a stop at 24. That's today's high. Okay. And where do I think my downside target is? Well, with this chart pattern, we're probably looking at, small support here at 20, potential to break down towards the $19, $18 level. Okay. Go price the options. What's the value of the option at 20? What's the value at the option at 24? What's your risk? What's your reward? Are you comfortable with that? And run with it. Okay. Let's take Tesla. Okay. And here's my problem with Tesla. I love Tesla short. Okay. I believe Tesla goes to double digits. Not that it's worth double digits. Not that it deserves to go to double digits. But something that has been short squeezed up so high and starts to fall, typically will exaggerate on the downside. And I expect some sort of exaggeration. It'll probably snap back off of that level pretty fast. You'll probably be able to play some really nice calls under 100 to get a snapback towards 150. But where's the risk? Where's the reward here on Tesla? Okay, and if you do that calculation, you'll find the options are pretty expensive. So you pretty much need Tesla to move to 120, 110 to be in a good position from a risk reward standpoint, unless you're using an ultra tight stop like 140. If you're using 140 as your stop, you can get a pretty good risk reward ratio. But if you use something a little more realistic like 150 or 155, your risk reward ratio doesn't look nearly as good. EOG, okay? Where's your risk? Where's your reward? I mean, where if you buy puts on EOG, okay? Let's just say you buy puts on EOG. Where do you say, you know what, I'm wrong and I'm out? Where? 170, 171, 172, 170. Well, there's not a clear mark here. Okay, there's not a clear mark. And this is one of the reasons why we like to use the 7-day moving average, because it tends to give a guideline. It's not perfect. There's nothing magical about the 7-day moving average, but it gives a guide that you can run with. So I would say, all right, if I'm going to short EOG here, okay, and I'll talk about this on the call side too, but if I'm going to short it, I'm going to use the 7-day moving average. We close above that level, I want to be out. So that's at 170.88. So I'll say, all right, we close above 171, I want to be out. What's my risk? Well, we're at 169. We go above 171, I want to be out, so I have about $2 risk. That's what I can control. Where's my reward potential? How low does this go? Does it come down? Does it fill this shadow here on the candle from last Thursday? Okay, probably. So 165 would be a conservative target. Okay, a more aggressive target, you're looking at this action from back here in August on their earnings. So you're saying somewhere in the 155 to 160 area as a final target. Does the risk reward make sense with the options? Okay, does it make sense with the options? If you're looking at it from a call standpoint, you're looking to buy it. All right, fine. Where's your stop? All right, put it on yesterday's low. Okay, you have a nice little piercing line candle. Okay, you put it on yesterday's low. And where do you think it probably will bounce to? Maybe 175? Okay, go price it with 165 as the stop, 175 as the price target. Okay. Then that's just a matter of going through and pricing the option through this little calculator here. PW, you make a great point. You say, so it's very important that the target is realistic. Is that the most critical calculation? Yeah, absolutely. For me, number one is the risk. Is my risk realistic? Am I pricing that incorrectly? Number two is, what about the price target? Does that really make sense? Okay. One of the things that I tend to do, is when I'm playing an upside trade, I tend to be really concerned with the price target. When I'm playing a downside trade or a put, I'm not nearly as concerned about the price target. So OIH. Okay, why would I not be as concerned about the price target? Simple. Because puts, what happens is when they start to fall, when the stock starts to fall, the implied volatility on the puts rises. Okay, and so that will actually help me build some gains. Plus, things are also not in 2013, but historically they tend to fall faster than they rise. They tend to overshoot to the downside more than they overshoot to the upside. Okay, so I can go price a put at maybe a 2-to-1 ratio, but I know there's a better chance of it being 3-to-1, 4-to-1 than what a call would be in general. Okay. So we can do that with AT&T, Alcoa, right? Something like Alcoa. Very difficult to trade right here. Why? Well, what's a realistic stop? What's a realistic price target? Yeah, it's probably going to go lower. But where? 860? Where's your stop? 940? 920? Where do you want to put those? Is there a really good area to put those? With Alcoa, there's not. We have support right here at 860, and that's only 30 cents away. We have some resistance. You could argue this gap here from beginning of November. You got about equal reward to risk. Yeah, you may be right, but flip a coin, 50-50, just not nearly as compelling as it would be from a better support or resistance level. Okay. AT&T. Okay, AT&T. Okay, you want to be a buyer of AT&T, for example. Where's your stop? Okay, well, 35 has been building as some support. It may exaggerate a little bit. You say, do you want it tight on 35? Do you want to close below 35? Where do you want to place that? Do you want to use yesterday's low? I'd probably use yesterday's low if I was getting in on the upside. Okay, where's your reward potential? Realistically, probably only about 36, 36.20. Okay, now you have to go price it out. Does it make sense? It doesn't make sense. No matter whether you think the stock's going to go up or down, it comes down to, well, where's the risk reward make sense? Okay, where does it make sense? Look, some of you argued with me about Capital One and said, Jeff, Capital One's probably going to go higher. Okay, and you've been right. All right, absolutely. But why would I stay in it? Okay, why would I stay in it? Well, 70 here was a pretty good resistance point. If this broke down, we're probably looking at going towards 67, 66. The reward on it relative to my risk to cash out 2 days ago, my overall risk 2 days ago versus what the reward potential, we're looking at a very nice ratio. Yeah, did it work? No. But I don't need everything to work to be in a very good position of profit. Okay. Now I need a little bit, right? I need a little bit. I can't go on a 8 in a row losing streak type thing. Okay. So the challenge. Okay, the challenge. We control the risk in two ways. Okay, and a lot of people look at the challenge and say, "Wow, this is risky trading." Okay, but the whole premise of this is controlling the risk. How do we control it first? We control it with the amount of money that we're going to use. Okay, we're not going to sit there and risk a $20,000 account. We're not going to sit there and risk a $50,000 account. Whatever. You're not going to risk your retirement funds or anything like that. That's not what this is about. The challenge is about taking a smaller amount of money, okay, knowing that's our risk, and using proper risk reward ratios to come into play there. Okay. TradeHound, great question. You say, is that why you seem to be looking for more short opportunities? Absolutely. Absolutely. Look, if I'm back in my fund managing days, and we've talked about this the last 3 months, I'm not able to be short the market here. I have to be long. The market is forced that position. Okay, from a fund managing retirement standpoint, it has forced that position. It continues to force that position. Okay, you talk to any fund manager that's out there, there are very few of them that are short this market because they can't. The risk of them being short, knowing, all right, the market's up 25%. If I'm short and I'm wrong, I'm going to underperform the market way too much, and I'm going to risk losing my clients. From a trade standpoint, from a challenge standpoint, we don't have to look at it that way. We look at it from this. I look at it from this perspective, right? Let me just back the chart up here. Let's go to. Let's just go to 2010. Okay, 2010. Let's just go to February. Okay. 0201. And 2010, let's just go to September. Okay, so here's 2010. And quantitative easing, first started, being talked about, various things. And one of the things that happened here in 2010, let me bring up the market. Looks a little better. Okay, there was no reason not to be a buyer up here. The bullishness overall was thick. We had seen the market go up 2010. We'd seen the market go up 2012. We had seen a correction in January, February. Market was on a tear. It was hitting new highs almost every day. It had a couple pullbacks only to rally. Okay, only to rally there. And the market was in such a position of bullishness. Options were just dirt cheap. Okay, what do you think happened to options in these 3 days? Yes, this one day is the flash crash. Take out the flash crash. Take out the long wick. Okay, the market before it had the flash crash was already down 2% before it rolled into the crash. In fact, we took off our puts before the actual crash, and we watched it crash down, and we're like, whoa. But these 3 days, what do you think happened to put options in 3 days? With the implied volatility, with the stocks going down, we're not talking about 100% gains here. We're not talking about 200. We're not talking about 300. We're talking about 4, 5, 600% gains in a matter of 3 days when the market's in such a hugely bullish position. Why? Because the options were dirt cheap, and the downside gives us more of that potential. So whenever the market is in a place where it's a little bit of a coin flip to me, and I'm dealing with the challenge, I will have a short bias, knowing I probably won't be right as much. Okay, I probably won't be right as much, but my risk to reward ratio is so much better. Okay, so much better that I only have to be right a little bit. Okay, and it becomes fantastic. This was a saving time for me, actually. We had been playing long in our fund through February, March. About April, we started to short. Things started to look toppy into the end of March, and it was just a very frustrating 3-week period overall. And, with that, we didn't have to have a lot of money in risk. We didn't have a lot of money at play. We basically had a little bit to the downside. It only took took 3 days, and take the flash crash out. 3 days to really recover everything and to be strongly in the green. So the bottom line, the challenge takes advantage of risk reward in that way. From the dollar amount we use, okay, yes, as the challenge amount grows, yes, we'll put more money in play. But as it grows, we continue with this risk to reward ratio with every trade. Where's our risk? Where's our reward? We understand that yes, 100%, we may be in calls and there's a flash crash and we're done. But we stick on this mentality, and over time we're right. Even 40-45% of the time we're going to make money. Okay, if we're only right 30% of the time, yeah, we could still make money. Prove that on the March challenge of this year. But anything up in the 60-70% area, we're golden. Okay. Alrighty, so that's risk reward. Any questions, please let us know. We'll continue to talk about this with each and every trade that we make, and go from there. Thanks for hopping on. We'll talk to you later. Take care.